Hello and a warm welcome to this ICAS webinar. I'm David Mingus, Director of Practice at ICAS, and it's my great pleasure to be guiding you through this webinar. Well, our Spring Tax Update series continues to be one of the most popular and highly ranked membership technical updates that we provide at ICAS. Over the past few weeks, in the first and second of our Spring Tax Update series, we've delved into the detail of recent developments in employment taxes and taxes which primarily affect owner-managed businesses. The feedback on those webinars has been excellent, and I would like to thank everyone who's taken the time to join us, submit questions, and follow up on the topics covered in those webinars. In case you've missed out and wish to catch up, you can, of course, access the recordings and the slides from our previous webinars in the past webinars section at icas.com/webinars. So in this, the final of our 3 spring tax updates, we'll be concentrating on the tax system beyond employment taxes and owner-managed businesses. So what were the key points from the spring budget statement? How will these affect client decisions and tax advisors' advice? And what have ICAS been doing to represent members' views and dealing with tackling service issues with HMRC? Well, to help explain and help us understand some of those matters, I'm delighted to be joined by Susan Cattell, Head of Tax Technical Policy here at ICAS. Susan works closely with the ICAS Tax Board on the direction of ICAS tax policy and is Secretary to the International and Large Business Taxes Committee, the Private Client Committee and the Indirect Taxes Committee. Susan also represents ICAS on various HMRC stakeholder groups and at various ad hoc meetings to discuss consultations and other specific issues. She's also the ICAS representative on the Charter Stakeholder Group. Well, before we begin, just a few housekeeping matters to remind you of. You can, of course, submit questions at any time through the live Q&A facility, which can be accessed at the bottom of your screen. Questions can be submitted anonymously or only to the presenters of this webinar if you wish, and we won't identify those who are submitting the questions when we ask them, so don't be shy in doing so. Please also join the conversation today through the discussion forum, which again can be also accessed at the bottom of your screen. And this allows you to comment on matters covered by this webinar or discuss them with your fellow attendees. We are, of course, recording this webinar and will be making it available for on-demand viewing afterwards in case you want to refer back to it or, of course, share it with others. And you'll be able to find the slides for this webinar alongside the on-demand video at icas.com/webinars. So we do look forward to receiving your questions, and of course we'll try to get to as many of those as possible. I know Susan has an awful lot to get through, so Susan, without me taking up any further time, I'm going to hand straight across to you.
Thank you, David. Right, as David said, today we're having a general taxes update, so we're going to look at developments across the main taxes, particularly things from the budget and the finance bill. 2 things to note: the finance bill is not final yet, it's still going through its parliamentary stages, so do double check for any amendments as it progresses towards being the Finance Act. Second thing to note, I can't cover all the developments from the budget and finance bill. It might have felt like a relatively quiet budget, but there are actually too many things to cover in a 1-hour session. But do go and have a look at the government publication, the overview of tax legislation and rates, if you would like a sort of more comprehensive list of everything with links into the detail. Apart from that, we're going to cover, I want to do a quick update on the project to improve standards in tax advice, and I want to conclude by saying a few words about the work we do with your input to try and improve HMRC services and systems. So without further ado, and the slides got ahead of me, let's talk about income tax rates and allowances. And some of you who came to the session at the end of last year will know that this slide really largely comes from there, because nothing's really changed. The big freeze in rates and allowances and thresholds carries on into 2023-24. So I'm just bringing them up on the screen. The personal allowance is frozen, the basic rate threshold is frozen, the higher rate threshold is frozen. The class 1 NICS alignments haven't changed. The thing that has changed from April 2023 is that the additional rate threshold has been reduced to 125,140. So that's affecting the highest earners. And the income tax rates are unchanged. Now, the interesting thing is that the plan is to freeze all these things until April 2028, as it says on the slide. And it's estimated that that will create 3.2 million new taxpayers and 2.6 million new higher rate taxpayers. And the Office for Budget Responsibility noted that this freeze in the personal allowance means that by 27-28, the real value of the personal allowance will be back to its 2013-14 level. And that's really what's behind this last question on the slide. Will there be a thaw in 24? Because there is this small matter of a general election at the end of 2024. Well, it has to be by the end of 2024. So I suppose that I have already seen some speculation, I'm sure you've already seen it as well, as to whether the Chancellor might actually want to find a few giveaways between now and next year. So I leave that as an open question for you to think about. Let's move on to Scottish income tax, because the Scottish government, they did actually freeze a few things as well. Their budget was at the end of December, in December, and they've left the starter and basic rate bands unchanged. They've left the higher rate threshold unchanged. And don't forget that the Scottish income tax has 5 different rates and bands. What they did do was to align their top rate threshold with the top rate threshold in the rest of the UK. And they left the lowest 3 rates unchanged. So the starter, basic and intermediate rates are unchanged. So that's the lower earners not doing so badly. But then what they did was increase the higher and top rates by another 1% to 42 and 47%. So that, of course, is further increasing the gap between the rest of the UK rates for higher earners and the rates for Scottish taxpayers. And I think that the Scottish Government clearly is very much thinking about this, because in their analysis of their budget decisions, they pointed out that 39% of Scottish adults don't actually pay tax because their income's below the personal allowance. And 50% of adults pay at the starter, basic rate or intermediate rate, and only 11% pay at the higher rate and 0.7% pay at the top rate. But 65% of total income tax take in 23-4 is expected to come from those higher rate and top rate payers. So that's a really tiny percentage of taxpayers contributing the majority of the income tax take. And it's obviously something that the Scottish Government has in mind, because I suppose eventually some of those people who are probably highly mobile may decide that actually they can just as well live in Carlisle rather than the other side of the border and not have to pay those higher rates. Or there are other things they might incorporate if they're self-employed. So that's something the Scottish Government clearly have in mind if you look at their distribution and analysis paper. Right, dividends and saving rates for 23-24. Now, essentially, this is the same as 2022 in terms of the rates, because you will remember that the dividend tax rates went up by 1.25% from April 2022. This was meant to be the equivalent of the 1.25% increase on NICs for employees. Now, the 1.25% for employees was removed, but it wasn't removed for dividends. So this last year and this year, the dividend rates are as set out on the slide. I'm not going to read them out. The big change, though, is that the tax-free allowance for dividend income is reducing from £2,000 last year to £1,000 from 6th of April 23, and it's going to reduce again to £500 from 6th of April 24. Now, this is obviously aimed at people who own their own companies, paying themselves in dividends rather than salary. But of course, the trouble is that it will hit everybody else as well. So, for example, if you've got maybe a pensioner who's got a small share portfolio, they were probably within the 2,000 tax-free allowance. They may well not be within 1,000 or 500. So they've got to think about telling HMRC about that income, and they've got to know that they need to do it. They've got to realise that the change has happened. The starting rate limit for savings and the starting rate for savings, they haven't changed. The reason behind the government doing this, of course, is that it's expected to raise money. There's a temporary drop expected this year because of behaviour change, people maybe having brought forward some dividends or postponing them. But going forward, it's expected to raise 450 million, rising to 940 million in 27-28. We go on to capital gains tax. The annual exempt allowance was 12,300 for 2022-23, and you only had to report, if you didn't have any tax to pay because it was covered by the AEA, you only had to report the gain where the total consideration for disposals in the year exceeded 4 times the AEA. But what's happening is that the AEA is just being drastically reduced. So as you can see, it's going down to 6,000. Let's concentrate on individuals. 6,000 for individuals, and then it's 3,000 from 2024-5 onwards. Now, in an outbreak of common sense, the CGT proceeds reporting limit has been fixed at 50,000, because obviously if it had been 4 times sort of 3,000, that would have meant lots of reporting for gains where there was no tax to pay. So that's at least helpful. The problem, of course, is that lots of people won't be aware of this. They won't even have thought about capital gains, and they won't realise. And in some cases, they might also realise too late, because, for example, if you've got to report something that needs to go into the CGT property disposals reporting service, you've got to do it within 60 days. And so I think there's going to be some problems with this. And obviously, there's going to be a lot of people reporting very small gains. So admin burden on them, admin burden on HMRC processing it, lots of HMRC helplines being deluged with people who can't cope with CGT real-time reporting or CGT property reporting systems. The Office for Tax Simplification, when it had a look at whether you might want to decrease the limit, did sort of say, well, maybe you should do some other mitigations as well, but those haven't happened. So this is probably going to be a problem area, and you might well get people coming to you asking for help, if I say they realise at all that there's a potential problem. CGT rates haven't changed. Just to give you an idea, the expectation is that these reductions in the rates will bring about 260,000 trusts and individuals into CGT for the first time. So that's a guess at the size of the potential issues. Right. Capital gains on separation and divorce. This is some good news. There's always been something of a problem for people separating and divorcing, and this covers spouses and civil partners, because under Section 58 tax TCGA, whilst you're still living together, you can make a no gain, no loss transfer between spouses. And that means that in effect, any gain is held over until the recipient spouse sells the asset. But the problem was that, of course, when people were separating or divorcing, they were only able to do no gain, no loss transfers until the end of the year of separation, because after that they wouldn't be living together, and that was a huge problem. So fortunately, after some consultation, the government has decided to make some changes. Now, I've said very clearly on this slide, do check for any amendments as the finance bill passes through Parliament. The only reason I say that is because in this instance, this legislation was not published in draft for consultation last year. So there can be changes to any bits of the finance bill, but this is perhaps going to be particularly susceptible to that. So what's going to happen is that separating spouses and civil partners will have up to 3 years to make no gain, no loss transfers. That's 3 years after the year in which they cease to live together. So that gives a lot more time to sort out the financial settlements. There will also be no gain, no loss transfers if assets are transferred as part of a formal divorce settlement. And then a couple more points. There's often one of the spouses might stay in the former matrimonial home, but their ex-partner or spouse might retain an interest. Well, they'll still be able to claim private residence relief when it's eventually sold. And there's a similar provision where they transfer their interest, but they're entitled to a percentage of the proceeds when they're sold. So this is all really helpful, and the changes will take effect for disposals made on or after 6th of April 2023. Right, now just to move away from the Finance Act and the budget for a moment, I just wanted to draw your attention to a couple of things that we've been working on recently. And The first one is some really good news for Scottish partnerships, because there was a problem emerged in 2019 with the rollover style relief that's available under section 248A, where partnerships sort of in effect they break up and the former joint owners of the land through the partnership exchange their interests so that each owner is left owning one or more parcels of land individually. So you see this quite often, maybe if farming partnerships decide they want to go their own way. Now, everybody had, I think, really assumed that you could have relief under section 248A whether you were a Scottish partnership or an English partnership. And then at the beginning of 2019, HMRC turned down a clearance application on the basis that a Scottish partnership had not held the land jointly, because a Scottish partnership is a legal entity, unlike an English one. Now, this wouldn't have affected all Scottish partnerships because some of them, the partners held the land in trust anyway, but it did affect a Scottish partnership holding the land. Now, there was no obvious reason why this should be the case. We also thought that the Saltoun principle, which is a principle from case law, that Scottish taxpayers should not be disadvantaged under legislation affecting the whole of the UK just because there's a difference in Scottish law. But HMRC thought that didn't apply. So we put in a budget representation in 2020, and I'm pleased to say that after a certain amount of extensive negotiation, providing evidence and goodness knows what, really pleased that we managed to see the clause in this year's finance bill. The finance bill says it's effective for disposals to be made on or after 6th of April 2023. Obviously, until the Act has royal assent, I suppose you can't be 100% certain of that, but that's the expectation. And clearly, whilst we were all talking about Scottish partnerships, they realised this is a problem for LLPs too, and that it also affects section 248E. So that's really good news, and that was something that really was down to sort of ICAS highlighting this, pursuing it, providing evidence. Something else we've done recently didn't require a change in the legislation, but I had a lot of problems raised with me about the section 49 TCGA time limit. So this allows you to recalculate a chargeable gain where a contingent liability is enforced. So this might happen where somebody's been running the company for many years and then they sell the company to the purchaser. They give the purchaser warranties and indemnities. And so a few years down the line, the purchaser says, oh, look, you overstated the sales. I'm going to claim under the warranty. Now, say you were paid 2 million for the shares originally, you have to pay 500,000 of that back. So you want to get the gain calculated because you've paid tax as though you received 2 million. And the time limit for making a Section 49 claim, there was a widespread belief amongst agents and HMRC caseworkers that the time limit is 4 years from the year of disposal. And that was a problem because most of the warranties and indemnities in contracts, they run for 6 years. So you could potentially have a claim being made against you at a time when it was already too late to claim the relief under Section 49. So we took this to the Capital Taxes Liaison Group in March, and I had a look at the revenue manual actually at the time and thought, well, that's interesting because the revenue manual seemed to suggest that that might not be the time limit. And indeed, at the meeting, HMRC clarified that we weren't the only people to have raised this, and they had actually tweaked the manual in February. But as I'd discovered, it wasn't very clear. But their view is that the time limit, which is the general time limit from Section 43 Taxes Management Act, that time limit runs from the date when all the conditions for making a claim are satisfied. So that would be the point, maybe in year 5, when that warranty came to pass, you had to pay up. So if you didn't know about it until year 5, it doesn't matter because the time limit doesn't start to run until the conditions for making a claim are satisfied. And because we said in the meeting that it still wasn't very clear, particularly given that we knew of live cases where HMRC caseworkers were saying it was 4 years from the year of disposal, HMRC have now added a line and an example to the capital gains tax manual section, clarifying the point completely. And they've done something similar for section 48, which is it's the same sort of thing. You sell the shares for an amount of money plus some extra money to come in future years because you know the amount you're assessed on it, but some of that money then doesn't materialize. So there was a similar issue with the time limit. So that's a couple of pieces of really good news. Inheritance tax, I'm going to dash through this slide fairly fast because essentially, as I'm sure you all know, the nil rate band and the residential nil rate band have been frozen since 2009-10 or more recently for the RNRB, and they're not expected to go up between now and 27-28. They're remaining at this point. And the extension of the freeze is, as it says on the slide, it's going to bring more estates into the charge, but the majority of estates are still expected not to pay any tax. Not quite sure how that works with the soaring property prices down here in London and the South East, and probably in Edinburgh as well, but there you go. So let's leap on to an area that did cause some controversy in Budget 23. The Chancellor made some fairly significant changes to the pensions rules. The problem is that ever since the big bang on pensions in 2006, these changes happen all the time, which makes it very difficult for people to do long-term planning, and particularly because the lifetime allowance and the contributions allowance keep changing, and every time they change you get protected rights, particularly to the lifetime allowance, which makes it very complicated. So what the Chancellor's tried to do is to reverse some of those reductions, both in the contributions limit and the amount you can save over your entire life without facing punitive tax charges. We've got the contributions annual allowance going from 40 to 60,000. The money purchase annual allowance, which applies where you've taken some money from your pension pot already, but you want to make more contributions. And the minimum tapered annual allowance, which applies where your income's above a certain threshold. Those have all been increased. And then going on to the lifetime allowance, this was probably the bit that attracted the most press comment. The lifetime allowance, which is the amount you can save over your lifetime, and if you go over it, you face punitive tax charges. Well, the lifetime allowance charge is going to be removed from 6th of April 23, and the lifetime allowance will be abolished completely from April 2024 in a future finance bill. This had a knock-on impact on the pension commencement lump sum, which is the amount of money you can take as a tax-free lump sum when you start drawing down from your pension. It used to be uncapped, but because obviously you take now, sorry, the cap was 25% of the available LTA, but because they're going to abolish the LTA, they've capped it at 25% of the latest LTA. Now, obviously, I said at the beginning that there's quite a problem here with it constantly changing. This is a very specialist area. It's one where people should always take specialist advice. And of course, I'm sure you're aware that the Labour Party was saying that if they became the next government, they might be reversing this. So I think, as I say, definitely a specialist area, one to go and take specialist advice about. Piece of good news on the pensions front, which didn't get as much publicity. In fact, I don't think I saw any publicity for it. The government had a consultation a while ago on how to help very low income individuals in net pay occupational pension schemes. There are two main types of occupational pension scheme. One operates on a net pay basis and the other operates on relief at source. Now, if you're an individual with income below the personal allowance, in a relief at source scheme, you still get a top up for, in effect, the tax relief. But if you're in a net pay scheme, you don't. So those individuals were worse off. So this change will mean that those individuals whose income is below the personal allowance and they're in a pension scheme using net pay arrangements will get a top up. Now, it's obviously quite difficult for HMRC to put in place the mechanism to do this. So they were given some time to do it. It's coming in with effect from 24-25. Legislation is in the current finance bill. I noticed that it says that HMRC will make the top-up payments as soon as possible after the tax year in question, which may indicate that they're still working on the mechanics. I think they've got to put an IT system in place. So we shall see how effective it is when it comes in. But on the face of it, that's definitely good news and addresses a sort of unfairness in the system. Right, let's move on to business taxes. I'm going to go very quickly through this slide because I know that Chris, who did the second OMB this in enormous detail with lots of examples. So if you really want to know all about marginal relief, then please do go and look at the recording of Chris's webinar, because all I'm going to say is that we've now lost, there was a huge simplification a few years ago when we ended up with one single CT main rate of, one single CT rate, 19%. Now we're going back to having two rates, the main rate of 25% for profits above 250,000 and for all close investment holding companies, and a small profits rate of 19% for companies with profits of 50,000 or less, and then you get marginal relief in between. So this is a complication, but you can see why the government has done it, because obviously they need the money, and it's a way of getting some money from the larger corporates. But so I say, if you want more detail on that and some worked examples, go and listen to the recording of Chris's webinar. But the one thing I would also say is that there is an opportunity for some of that money to be clawed back by companies, if you like. So let's just have a quick look at capital allowances. And again, if you want more detail on this, go and listen to Chris's webinar. But the headlines here are: the annual investment allowance. The Spring Finance Bill provides that it will be permanently fixed at 1 million. I've put my own inverted commas around permanently, because we've heard that before, and it's permanent until a chancellor decides that they'd like to tinker with it again, which unfortunately has happened quite a lot. But if it is fixed at 1 million for a significant period of time, that's really useful for smaller businesses, because it probably covers virtually all their capital expenditure, if not all of it. So they don't then need to worry further. For reasons which will become clear in a minute, it's also useful for unincorporated businesses, because what the Chancellor is bringing in this year is that he's replacing the super deduction, which is that was a temporary 130% super deduction, and that came to an end at 31st March 2023. That was only available to companies, it was only available on certain types of asset, and companies disposing that. Don't sort of throw away all your records, because if a company disposes of an asset on which super deduction was claimed, it's going to be subject to a balancing charge, and there is some helpful guidance from the government on how to calculate that. Now, to replace the super deduction, we have full expensing coming in, but again, that's only for 3 years to 31st of March 26. That's in the current finance bill. Also only available to companies, which is why the 1 million AIA is significant for large unincorporated businesses. It's 100% first year relief on main pool plant and machinery, 50% special rate assets, has to be new and unused plant and machinery. There will again be balancing charges on disposals, and cars and assets for leasing are excluded. Other than that, this rather limited category of background plant or machinery for a building is only relevant to a very small number of people. Now, I think that point about assets for leasing, there is a working group which I've attended to have a look at whether there's any possibility of extending for full expensing to leasing. And I would welcome any input on that. I'm going to put up our mailbox later, but if anybody's got any feedback on that, please drop an email to the tax mailbox, because I think the difficulty is that leasing has in the past been the subject of considerable amounts of avoidance. That's why it's currently excluded. So bear that in mind if you've got any views on whether it would be useful to extend it to leasing and how that kind of abuse could be prevented. Now, I should note this is only for 3 years, and the Office for Budget Responsibility has commented that they think that means it won't actually increase business investment overall, which is what it's supposed to do, because people will just bring forward stuff. And I know from feedback that we've had that if you have some large businesses, just plan so far in advance that if something's only going to last 3 years, then it's not really much use, because it's too late. They can't change their plans at that point. Now, the OBR did say that it probably would increase investment if the Chancellor extended it to be permanent, which he said he would like to do when financial conditions permit. So the only problem with that is, though, that the OBR thought it would cost about 10 billion a year. So that's going to be something for the Chancellor to think about fairly hard as to whether he will be able to make it permanent. But it certainly, in terms of getting actually a long-term increase in investment, making it permanent is what the OBR thinks would be a good plan. Right. I just want to say one other thing. The first year allowances available for electric vehicle charge points, that the availability of those allowances has been extended until 31st of March 25 or April 25 if you're an income tax payer. And that really does make sense, because the the 100% first year allowance for zero emission goods vehicles and for zero emission cars, those have already been extended to 2025. So it would make sense for you to have the charge points for the people to plug their zero emissions cars into. So if you're eligible to get that, then it's now been extended to April 2025. Now, I wanted to say a few words about research and development, because there's been a lot of change and announcements in this area. And also, I'm sure some of you have got clients who've been affected. HMRC have been cracking down on rogue claims. This is a huge problem with various agents who are not usually members of professional bodies going out and approaching other people's clients, as it were, and saying, look, you can claim some R&D, including sort of ridiculous things like new menus in restaurants. So HMRC has been having a crackdown, but has held up the processing of claims. And some of the changes that I'm going to just run through are aimed at tackling that. Right, first changes, Autumn Statement 2022. The RDEC rate, that's the large business R&D scheme, is increasing, as you can see, but the SME scheme rates are reducing, and the SME credit rate for loss makers also reducing to 10%. Now, the intention, the government said, was to enhance the competitiveness of the large business scheme and pave the way for a single scheme based on the RDEC scheme. That was legislated in the finance bill that got royal assent this year, so it's now the Finance Act 23. Just after it got royal assent, we got a consultation published on this proposed single scheme. Now, ICAS, as you can see, we responded to this and we supported the proposal for a single simplified scheme based on RDEC. We did suggest a few modifications, but we were broadly supported, because it would be simpler to have one scheme that everybody was in, and you didn't have the problems with interactions between the two schemes that you have with the current arrangements. One of the questions was whether there should be additional support for different types of R&D or for R&D intensive companies, and we thought not, because that reduces the simplicity, and if you want to give targeted support, you could do it through other means like grants. Now, if we move on to the budget, what the Chancellor announced in the budget, oh, sorry, I've just moved too far, apologies. What the Chancellor announced in the budget was that he is actually going to renege slightly on what he announced in the autumn statement, in that if you're an intensive R&D SME, where R&D constitutes at least 40% of your total expenditure, you will still get that payable credit rate of 14.5%. It won't reduce to 10%. And that's effective from 1st of April 2023, in effect, when the cut that was announced in the autumn came in. But we don't know any more details, because the draft legislation is only going to come out in the summer. He also said that no decision has been reached on having a merged scheme, which is not a surprise because the consultation has only just closed. But the draft legislation is going to be published for technical consultation in the summer. So they're obviously clearly actively still thinking about having a merged scheme. And you'll see that there's a link to an article on the website if you want a bit more information about that merge, the consultation, and our ICAS response to it. Now, the government had already promised to expand the meaning of R&D for tax purposes to make clear that it included pure mathematics, and that's now happened. It didn't need to be in the finance bill. They were able to introduce the guidance, and you can see it's now section 15B. So pure mathematics now counts. The current finance bill includes legislation to also do something else they promised, which was to expand qualifying expenditure to include the cost of data licenses and cloud computing. The other thing that's in the finance bill, and this is about tackling abuse, is that companies will have to notify HMRC of their intention to claim R&D relief unless they've claimed R&D in the previous 3 years. And the deadline for submission of the notification, it has to be a digital notification 6 months after the period of account for which they want to claim. And the risk is that that will catch out lots of startups who simply don't realise perhaps that they've done R&D until it's too late, or don't realise they have to tell HMRC about it in this pre-notification. So it's really important to raise awareness if you've got clients who might be, you know, who do R&D and who are new and haven't claimed it before. Now, those two changes take effect for accounting periods beginning on or after 1st of April 23. But as you can see, the last bullet point, all companies claiming R&D have got to give additional information about their claims, again, digitally, for claims made on or after 1st of August 23. And again, that's about tackling abuse, because it's going to give HMRC extra information to look at those claims. Some of you might recall that the government wanted to focus the relief on work carried out in the UK. So they were going to restrict overseas expenditure, but that's been delayed until April 2024. They'd already had to tweak it anyway because of the issue that, for example, if you're doing medical research, some of the trials for reasons might have to be done abroad. So they'd already had to tweak it for things like that, because obviously you wouldn't want to prevent that happening. But in any case, it's now been delayed so that they can look at the interaction with a possible single R&D scheme. So watch this space. Now, I don't want to say too much about this, because this only affects the really, really large multinational groups with 750 million turnover of more than 750 million euros. But I did just want to mention it in the interests of balance, really, because there's been a lot of comments about big companies not paying their fair share, and stories about, you know, companies with lots of income in the UK from UK customers who pay all the tax somewhere else. So I just wanted to say that we had the base erosion and profit shifting initiative from the OECD from 2015 onwards. The UK has been implementing all those measures. We've now reached the stage where the OECD are trying to tackle a particularly thorny area, which is the taxation of things like digital things. So you might have a big tech company that's got lots of users in the UK. I'm sure we can think of a number of examples, but the money is going somewhere else. So we've got pillar 1 and pillar 2, and what's happening at the moment. Pillar 1 is about where you allocate profits. Pillar 2 is about having a minimum tax rate, so that there, you know, there's no point multinational groups shifting their profits, because there won't be these significantly lower tax jurisdictions. The UK, the finance bill is implementing pillar 2 in the UK, and essentially, I'm not going to read out everything on the slide, but basically it's just saying, if you're a non-headquartered, so if you're headquartered in the UK, but you've got operations in a foreign jurisdiction where the tax rate's less than 15%, you'll have to pay a top-up tax to make it 15%. If you're UK headquartered, and you've got an effective tax rate in the UK of less than 15%, there'll be a domestic top-up tax. And that applies for accounting periods beginning on or after 31st of December 23. People are starting to think about this, because they've got to think about what they have to report in terms of the accounts. We had an interesting discussion at the recent International and Large Business Tax Committee meeting, what people were looking at on the accounts. There's been an exposure draft of amendments to the accounting standard. So really interesting things to look at if you're working with large corporates, or you work for a large corporate. Now, the other thing is that the UK, I said the UK had been implementing all the OECD base erosion and profit shifting measures to stop people shifting their profits to low tax jurisdictions. One of those areas, of course, is transfer pricing. And in fact, the UK hadn't implemented all of the OECD's guidelines around record keeping, because we'd already got our own arrangements, but we've now decided they weren't sufficient. So we are now going to require much, in effect, more record keeping. And we're still considering, HMRC still discussing whether to impose another requirement for people to tell them in more detail how they've prepared that documentation. Okay, so let's move on to VAT. Now, I'm going to not say very much about the second item on this slide, because it's rather been overtaken by events. But the VAT threshold, I did just want to say, because it's still frozen. It's not changed since April 2017. The problem with not changing it is that it causes a certain amount of distortion, in that lots of businesses think, well, last 3 months of the year, I just won't do any work. won't take on any jobs because I don't want to go over the 85,000 threshold. Now, with inflation, that's presumably getting much worse. And in fact, we know it's getting much worse because the Office for Budget Responsibility commented in March 23 on the growing distortion. And you'll see I've put some stats on the side. And the reason this is, I think, worth mentioning is that it means that, of course, those firms are not expanding, they're not taking on more employees, and the OBR has sort of said what it thinks the lost turnover will be. And they think that it's going to have almost doubled by 2026 to 350 million, and that the number of firms will have almost doubled as well. So it's really it's really interesting to see whether the government might decide to do something about this, but it is very difficult because, for example, if you decided to cut the VAT threshold, bring many more people in, and most countries do have in Europe have a lower VAT threshold. If you cut it, that will put prices up, and you might not want to do that in the middle of a cost of living crisis. So it's a difficult one for the government, but I would imagine it's on their agenda. Right, current finance bill. Now, I'm not going to spend a lot of time on this because this was going to be really important and was causing a certain amount of concern, because the Scottish Government was intending to bring in a deposit return scheme on bottles and cans from August 2023. And there was a certain amount of concern because nobody knew what the VAT rules were going to be. And as you can see, basically, that's been covered in the current finance bill, and more to the point, there are some draft regs with all the details. So that consultation on draft regs closes on 17th of May, and my colleague Justine is preparing a response to that. So I'm not going to say any more about it. If you want any more information, do go and have a look at Justine's article. But the reason I'm not saying any more about it is that the Scottish scheme is now being delayed. It's not going to come in until 24, and the scheme in the rest of the UK is not coming in anyway until 2025. So plenty of time now to sort that out. Right, I did want to say something about the new VAT registration service. Any of you do VAT registrations, I'm sure you will have had problems with this. It was launched last year in August. Unfortunately, the launch coincided with a major attack on HMRC's systems, which meant that they had to increase security checks. So whilst there were some problems with the new VRS, some of the problems were nothing to do with VRS and just to do with the more extensive security checks. But the net result was lots of delays, lots of problems. We had a series of meetings. I represent ICAS at the Joint VAT Consultative Committee, and there were also some bespoke meetings about problems with the VRS. Pleased to report that some of the problems with the system itself have now been fixed. There are some ongoing issues with delays, though. Now, as you can see from the slide, I put a link to an article about some of this on the website, but very recently, HMRC had managed to catch up, and processing of current VAT registration applications is within target, which is 40 days. Now, you might still have a few outliers because that is very recent. But HMRC would also like to reduce that 40 days because I'm sure you'll remember that it used to be much quicker. And so they're establishing a working group, which I have volunteered to join. So if anybody's got any feedback or any ideas as to how maybe they could tweak their processes a bit to make it easier, then do drop an email to the tax mailbox. Also, you go and have a look at the article because HMRC provided some tips back in January on how you might be able to help yourself not to get your application held up or your client's application. The other thing I just wanted to mention is that HMRC changed its option to tax processors. Very important to have evidence that you've opted to tax a building, particularly, for example, if you're doing a transfer of a going concern. There was a brief consultation at the end of last year, which we responded to, and the main changes are that HMRC stopped issuing the OTT notification receipt letters. So it's really important that you do the notifications exactly as they say by email with the right information in the subject matter so that you can keep the automated response as evidence of the opting. If you need to know the details on that, do go and have a look at Revenue and Customs Brief 123 because that sets them all out. It also sets out when HMRC will process requests to confirm the existence of an OTT, which is now in very restricted circumstances. So do go and have a look at that if this is something you deal with regularly for clients or you do it yourself. Right, tax administration. Now, I'm not going to talk in detail about this because Chris mentioned it in his webinar on for OMBs, and also there's a detailed article on the ICAS website. You'll see I've put a link on the slide to that. And there was another webinar back in February with all the details. So, and I'm just looking at the time. So I think I'm actually going to skip the rest, talking through the rest of this slide and move on. But do go and have a look at the detailed article on the webinar, which will set out the things that you might need to be looking at for both for the year of change, which is 24-25, and the transitional year for 23-24. And just to note, you'll see at the bottom of the slide that we belong to a stakeholder group on basis period reform. And one thing we are doing is pushing HMRC to get some proper mechanism for giving people overlap relief details. And you may have seen something about that in Agent Update. Right. This is just to draw your attention to the fact, again, there was a consultation and HMRC have brought in some easements, I think you would call them, for small trusts and estates. So it just allows them a bit of leeway in terms of what they do and don't have to report. So this is in the current finance bill. I'm not going to read out the contents of the slide to you. Just be aware, if you deal with small trusts, small estates, particularly trusts and estates with income that doesn't exceed £500, this is going to be really, really helpful. So do go and have a look at the details if you deal with small trusts and estates. Right, I did want to say a word about the abolition of tax, the Office of Tax Simplification. The Office of Tax Simplification was set up in July 2010 to provide independent advice to the Chancellor on simplifying the UK's tax system, put on a statutory footing in 2016. But Kwasi Kwarteng announced that he was going to abolish it, and it was one of the few things he announced when he was briefly Chancellor that wasn't then reversed by his predecessor. And we were quite disappointed about that because we've been strong supporters of the OTS. We contributed to its calls for evidence. We had 3 meetings with them last year on their most recent report. And we were concerned that tax simplification might simply be dropped because, I mean, it has been difficult. The government didn't by any means take up all the recommendations of the OTS, even when it was in existence. So there we are. But the Chancellor has assured us that that they are going to continue to look at tax simplification. And ICAS and the other professional bodies actually took the Chancellor at his word that it was still a priority, and we wrote a joint letter to the Financial Secretary, to the Treasury, calling for the government to take 9 actions to deliver on its promise that, you know, tax simplification will continue. You can go and find the details of that and the actual letter on the website, but I'm really pleased to say that we actually got invited to a meeting with the Financial Secretary to the Treasury to discuss the letter and our suggestions, and how, you know, we were saying we'd really like to help with this. What can we do? Had a really good meeting yesterday, which I attended with the other professional bodies. So that was really useful, and I do hope that it is going to result in some concrete actions around simplification, not just simplification of the underlying legislation, but of things like the processes. Right, something you might not have noticed, the Chancellor is removing the ability of charities outside the UK to claim UK charitable tax reliefs and exemptions. Now, the reason I've put this on the slide is that I think the main significance of this for most people, if you're not actually an overseas charity, because it would be EU and EA charities and community amateur sports clubs who will have been able to qualify for these reliefs and who now won't be able to from 15th of March 23. But the important point to note is that about 2,000 individuals were claiming higher rate relief on their donations to these non-UK charities. So, you know, for example, they might have been giving to some kind of Italian charity to rescue stray cats. And there's a transitional period for charities that HMRC had already accepted qualified for tax relief. So that gives people who are making these donations a bit of time to review their donations. They need to be aware that they won't get relief going forward after that transitional period. So it does affect all the other charitable reliefs as well, but I think that one's probably of the most mainstream interest. Now, I'm really keen to get on to the final section about talking about standards in tax advice. So I'm just going to say to you, this is a bit of a reminder if you're doing tax returns and people have made homes available under the Homes for Ukraine scheme. The government promised 31st of March 2022 that certain tax reliefs would not be affected if you made a home available, and also that the optional thank you payment made to individuals who were making homes available would not be taxable. Well, the current finance bill includes the legislation to honour that promise. So if you've got anybody coming to you and asking about this, go and have a look at the detail, but basically they're delivering on that promise from March 2022. Right, raising standards in the tax advice market. Way back in 2019, the independent loan charge review recommended that the government should have a look at the tax advice market and improve it, and it should also consider regulation, because at the moment anybody can set themselves up as a tax advisor and they don't have to follow any standards whatsoever, and they don't have to have any qualifications. So there's been a series of consultations. The latest two, the 2021 proposal to mandate professional indemnity insurance, they're not going ahead with that because various issues were raised about the effect that might have, so they decided not to do it. What they are going to do, though, there was another consultation in 2022 on repayment agents who were causing a lot of trouble with individuals, where they were making claims on individuals' behalves, and what people didn't realise was that they were signing up to give all their tax repayments, not just one for 1 year, but all of them, to a third party by signing the repayments. So to tackle that, the legislation is abolishing the use of tax repayments for assignment of tax repayments to a third party, and that's effective from 15th of March 2023. Also, these repayment agents will be required to register with HMRC within a 3-month window starting on 2nd of May 23. Now, I'm sure most of you probably thought they had to register anyway, but it's a bit of a surprise that they didn't, but they will have to, and that's quite important because then at least HMRC knows who they are. There was also going to be some more work on taxpayer consent to claims and a review of existing agent authorisation processes. Now, ICAS thinks that the real solution to all these consumer protection issues is that all tax agents should be required to belong to a professional body. We've said that repeatedly and in response to some of the earlier consultations. And we're still expecting a consultation on some form of statutory regulation, and that would be our recommendation, to make everybody join one of the professional bodies, particularly those that enforce professional conduct in relation to tax. And it will also include a definition of tax advice. Now, we don't know when that might be published. It's been expected for some time, but keep your eyes peeled for that. We will definitely be responding to that. The other thing I wanted to just mention, in case you've seen it and wondered what it was all about, is that HMRC has its own standard for agents, which sets out the standards it expects tax agents and tax advisors to adhere to, and says how HMRC will tackle agents who don't meet that standard. It does apply to all agents, and the most extreme sanction HMRC can apply, well, short of criminal prosecution, would be stopping an agent having access to HMRC services. Now, it does apply to all agents, but because HMRC broadly accepts that professional conduct in relation to tax, which would apply to all ICAS members of people, ICA, WC, IoT, and so on, HMRC kind of accepts that if you meet that, you're going to be meeting this. But they have published an updated version at the same time as they published that response to the repayment agents consultation. And the updated version actually adds some more detailed transparency requirements, including agreement of terms of engagements. In some respects, it now more closely aligns with PCRT, which is good, but there are a few problem areas. For example, reporting fraud, suspected fraud on part of clients to HMRC, which of course is an issue because of confidentiality and also because it should be the subject of a SARS report. So some of that and a number of other issues are currently under discussion with HMRC. Okay, final section. I just wanted to mention, now Chris talked about all three of those in his webinar for the OMB taxes. So we are going to be responding to those consultations. Do drop an email to tax@icas.com if you've got any views on any of them. Because Chris dealt with those, I won't go through those in detail. I'm going to pick up the three that came out on Tax Administration Day. Again, we're also planning to respond to these. And the first one's quite interesting. This is HMRC being able to take some individuals out of the normal rules and put them into a legislative sandbox to test possible changes. I think one possible concern about that is consent, you know, whether people will consent and what would happen if something went wrong partway through and they needed to leave this sandbox. So that we will definitely be looking at that one. Modernising HMRC's tax services, the second one, that's essentially about moving to a digital by default approach for lots of things. And one of the issues there is that some of those digital services don't exist or don't work very well. And the third one is about sorry, that was the previous slide. The second one is about pre-population of data, doing more, get HMRC collecting more data and pre-populating it. This has been looked at before, but it will require some changes. So if you've got any views about that, do let us know. I won't talk about off-payroll working, that's a fairly specific area, and my colleague Justine's dealing with that one. So finally, I just wanted to mention to you, and I've raised a couple of examples of this already. We in the ICAS tax team, we take issues reported to us by you through various, we take them to HMRC stakeholder groups, as I've mentioned several of those earlier today. We report them on the Agent Online Forum, not just issues with HMRC service levels or systems, but also things like the technical issues I mentioned earlier with Section 49. We also send letters, ICAS letters or joint letters with other professional bodies to HMRC and to the government. And I mentioned the one to the Financial Secretary of the Treasury, but we've also looked at things like service levels, HMRC resources. We're a member of the Charter Stakeholder Group, as David mentioned. I'm the ICAS rep, and every year HMRC has to report on its performance against the Charter standards. And the CSG group makes a contribution to that report. And this year we published a survey for all of our members to contribute, to tell us what they thought of how HMRC was doing against the standards. And we not only used that to write our contribution to the report, but we also sent HMRC the detailed survey findings. So I hope some of you filled that in. Do look out next year, because we'll be doing it all again next year, and we really want your feedback, because they have to publish that report. It gets discussed in Parliament and so on. So definitely worth making our views known there. And what could you do to help us? Well, what you can do is obviously email the mailbox with any feedback on any of the kind of issues we've talked about today. Think about signing up to the Agent Online Forum yourself. You might not want to make posts yourself, but one of the things we're encouraging HMRC to do is to make important announcements on there, including things that will take ages to get onto gov.uk. So if you sign up on there, you might get an early heads up on things that might be bothering you. Use the HMRC dashboard for agents. We asked HMRC to deliver this. They've delivered it, so do please go and use it, because it's really handy. It tells you how long HMRC are expecting it takes them to process important things like VAT registrations and everything else. And there's no point chasing something if the dashboard's telling you that they won't even have looked at it yet, because it doesn't help anybody if HMRC's helplines are deluged with people progress tracing for things that the dashboard says, well, we won't have looked at that yet. As I said, tell us if there's a problem with guidance. I mentioned that point about Section 49 guidance earlier. Also, do click on a page. If you're on a page in Revenue Manual or on gov.uk, there's a little box at the bottom where you can tick and give feedback. Was this page useful? Spot any problems. HMRC do look at that feedback, particularly on the manuals, which they control. Gov.uk is a bit trickier because they have to work through the gov.uk team. But do that, and do let us know if there's a problem, because we'll take it up. I mentioned the Charter Stakeholder Group. Let us know what you think about how they're performing against the Charter standards. Could you join an ICAS tax committee? There's going to be some adverts coming up soon for vacancies. We do have lots of interesting discussions at the committees. It's a way of giving us feedback. So do think about that too. And finally, if there's one big problem you're encountering at the moment with HMRC, do put it into the discussion forum. We're going to look for some common themes and see if there's anything that we can take up. Right, I can see that we're very nearly at the end of the session, so just made it to the end. So I hope that was useful, giving you some thoughts and maybe some things that you might consider doing to give us feedback. Thank you for joining us this morning.
Thank you very much, Susan. As you say, we are almost out of time, but as I say, thank you very much for joining us and covering such a comprehensive area of all the taxes and the latest developments that we've got there. So please do remember that you can keep up to date with all the latest tax and other professional news, including the latest information, guides and resources on ICAS.com. You can also access technical support, including the Tax Technical Help Desk, through the ICAS Technical Help Desk, which is available through the Contact Us section of our website, and which, in addition to tax, covers accounting, auditing, practice support, AML and ethics. Looking ahead, we've got a wide range of webinars coming up, which you might wish to sign up for. Next Wednesday at 11 o'clock, we're linking up with the Chartered Institute of Payroll Professionals for a Payroll Need to Know webinar, looking at expenses and benefits, with a focus on the new rules following the abolition of paper P11D and P11DBs. And on the 13th of June, Chris Campbell, our Head of Tax for Tax Practice and OMB Taxes, will be back with us looking at how to deal with the HMRC inquiries, an area which we know from members seems to be on the increase in HMRC compliance activities. Between those dates, on the 31st of May, you can join us for a face-to-face event in Glasgow for our first digital practice conference, where there will be a full day of in-person panel discussions, presentations and roundtables for you to hear about the latest accountancy trends and software, guided by the UK's leading accountancy firm mentors. So this strategy focused day will allow you to take a step back from the day-to-day and prioritise your own learning as you gather the knowledge required to implement meaningful changes that will help your firm be fit for the future. There's also a range of other webinars and face-to-face events coming up, the details of which are on the screen, and you can sign up to all those ICAS webinars and events at icas.com/events. It only leaves me to once again thank Susan and of course you, the audience, for joining us today, and I hope that the webinar has been helpful to you. And until the next time, goodbye.